What is up, everybody? Dan again, stocktrades.ca. Welcome back to the channel. So in this week's video, we're going to be going over a fund that was in high demand for me to have a look at. And primarily this is because it allows investors to get some pretty high exposure to a very expensive, but one of the best performing technology stocks on the Toronto Stock Exchange and in fact in North America over the last 10 to 15 years. And the fund I'm going to be going over is XIT, which is the iShares Canadian Technology ETF. So I'm going to go over some of the things in terms of concentration risk, the fees, the performance, all that stuff, so you can make a better decision as to whether or not it's right for your portfolio. So with that being said, let's dive right into it. But I do have a very important announcement first. Thank you so much for 16,000 subscribers. The reaction to us returning to YouTube has been absolutely huge. We're getting a bunch of views on our videos. We're getting a bunch of subscribers, a bunch of comments, emails, all that type of stuff. And as a gift back to subscribers, we're going to be giving away a couple premium subscriptions, which is a $300 a year platform that we run over at Stock Trades. All you need to do is like the video, subscribe to the channel, and head down below and comment. What I want to see in terms of comments is what fund you want me to review next. And next week, I will pick a couple random comments. I'll comment on them, get your email, and we'll set you up with a subscription. If you want to join the No BS newsletter, it is an absolutely free newsletter. We send it out twice a week. We're covering stock picks, market commentary, investment strategies, investment guides, personal finance stuff like best banking, things like that. Head down below. There's a link in the description. You can sign up for it. It's absolutely free, no gimmicks. And finally, Thursdays, I'm doing the Canadian Investor Podcast with Simone. You can find that on Apple Podcasts, Spotify. We're talking all things news, primarily Canadian stock earnings, but also a lot of US options as well. But with that said, let's dive right into this review of XIT. So XIT, what exactly is XIT? Well, if you're looking to grab a basket of Canadian technology stocks, you're definitely looking in the right direction here. Now, there's not too many technology ETFs here in Canada, primarily because there's just not a lot of tech stocks. So as a result, this iShares TSX Capped Info Tech ETF is probably the most popular. I mean, if we come down and look at, inflows over the last while, we can see that it's pretty steadily growing over the past 1, 3, 5, 10-year periods. And right now it sits at around $705 million in assets under management, which, considering the fact of how few tech companies we have here in Canada, that's actually not that bad. Now, when we look to the fees of the fund, you're going to pay 0.61%. This is a high fee, but it is also a niche fund. It aims to track the S&P TSX Capped Information Technology Index. Capped just means that a stock in the index is capped at a particular weight, and when it gets above that weight, they might choose to rebalance. So this is a index fund. It tracks the Canadian Tech Index, but it still charges fees of 0.61. And a lot of people may think that's pretty high, but considering the niche element of this ETF, it gives you exposure to a pretty tight-knit group of Canadian technology stocks. The fee is not all that outrageous. I mean, we see it plenty. We see it with plenty of REIT ETFs, things like that, where they'll have fees in this range as well, just because they're, a concentrated area, a more niche fund, and as a result, the management tends to charge more. And also, these niche ETFs tend to have tinier assets under management. I mean, when we look at $705 million, we could look at, let's say ZSP, like the BMO S&P 500 ETF. It has assets under management of, I think, $16 billion. So as a result, it can charge, a lower fee, because as AUM goes up, fees can go down because they can run the fund a little more efficiently, even on a lower fee. So when we look to the performance of XIT, it has been one of the best performing Canadian ETFs by a landslide over the last while. Year to date, it's up around 6%. We're in mid-March of 2024. 1 year, it's up 41%. 3-year annualized returns at 6.63. This isn't all that surprising because technology over the last 3 years, we did go through a severe correction, and this will be even more amplified when you realize what holdings this fund has. it's not surprising that it's only gained that over the last 3 years. But when we look to the long term, which is technically when we should be looking to buy these funds for, when the timeline we should be looking at to buy these funds for, we can see 5-year annualized returns of 20%. Now, this is an absurd return. This outpaces the S&P 500. This outpaces the NASDAQ. This outpaces, I would say, most every major index. Now, the reason for this is, again, going to be because of the holdings, which I'm going to talk about next. You may be wondering how this Canadian Tech ETF could crush the NASDAQ. Well, it's because of its top holdings. So we even span this out to 10-year returns, and we get to 19.4% and 15-year annualized returns of 18%. This fund has absolutely crushed it. You could have paid a 1 to 2% management fee on this fund and absolutely crushed it. So although the fees are high, I wouldn't get too caught up on, paying high fees, because this fund has absolutely killed it over the last while. When we go to the allocations of the fund, it's a pure tech ETF. It's a pure 100% Canadian tech ETF. We can see, 100% exposure to tech. Most of it is going to be large cap growth stocks. And again, I'm going to say it again, we're going to look at the holdings soon, but this is because of the top holdings in the fund. And, there's a few small caps, but really not that much, small to mid caps. For the most part, it is Canadian tech, but there is some US tech inside of it. And now that we go to the top holdings here, we can see why this fund has performed so well. We're sitting here looking at a 26% allocation to Shopify, a 24% allocation or 25% allocation to Constellation Software, and a near 20% allocation to CGI Inc. Now, why has this fund crushed it over the last while? Well, because these three stocks make up 70% of the fund, and they've absolutely killed it. If we look at the total returns of all these stocks over the long term, we can see, Shopify is sitting at, let's look at 5-year returns, 277% return over the last 5 years. Constellation is, let's click returns here. Constellation, 236%, and CGI, which I know has resurged as of late because of the overall AI boom, they're up 73.5% over the last 5 years. When the fund's top 3 holdings are killing it that much, obviously it's going to, cause outperformance. When we look to the bottom end of the holdings, the top 3 holdings make up 70% of the fund, and then, the next 2 holdings make up an additional 15%. So you're looking at around 85% of this fund being allocated to the top 5 stocks. The additional holdings being OpenText and the other being Descartes. I'm sorry if my French is really bad. Celestica, Kinaxis, Lightspeed. But once we get down to, Kinaxis, Lightspeed, BlackBerry, Enghouse, very small percentage. Like, these will have very little overall weight on the portfolio. And as we can see, it only contains 26 stocks. So once we get down to, the bottom end here, we even have a crypto miner in XIT. Bitfarms, I've actually never heard of them. I imagine there's some sort of cryptocurrency. Computer Modeling Group, interesting fact, this is actually one of the first stocks I ever bought when I started investing a long time ago. We have Docebo, which is a cloud-based learning platform. Converge Technology, I believe, is like an acquisition-heavy technology company. Enghouse used to be one of the best tech stocks in Canada, but has fallen off quite a bit as of late. As a result, it's got a fairly low weighting in this portfolio. I guess the one thing I would say about these holdings is they're very concentrated. You're buying an ETF of 26 Canadian technology stocks, but don't get this confused. This is a play primarily on 2 stocks, Shopify and Constellation Software. If they don't do well, they make up 50% of the fund. The fund will not do well. And for a lot of people, as I had mentioned earlier on in the video, Constellation Software trades in the high 3,700s. It's an expensive stock. So if you're not at a brokerage like Wealthsimple Trade, who can do fractional share ownership, a lot of people choose to get their exposure to Constellation Software and Shopify, which Shopify did a stock split, so it's not as expensive now. But they do this by owning XIT. It's an option for a lot of people who can't afford, maybe they have a $10,000 portfolio, they're just starting out, and they want to own Constellation Software, but they don't have $3,700. They don't want to put 37% of their portfolio into one holding. So this fund does make sense in that case. It's just important to understand that there's a lot of concentration here. Now, I really like the 5 companies in here. I mean, my technology exposure is primarily through Constellation Software. It's one of my largest positions, but I like Shopify, CGI, OpenText, Descartes. Like, they're all outstanding companies, but I just want to highlight that concentration risk just so you know that if Shopify and Constellation struggle moving forward, this fund will really struggle moving forward. So previous returns are never a guarantee of future returns. Now, I know I was talking about this fund and how it had crushed the NASDAQ and the S&P 500, and I'm sure you're wondering by how much. So I'll go over to the chart here. We'll put in total return, and we'll compare XIT to QQQ and SPY. So if we enter these in and we go to 10-year returns, you can see that I guess we'll go annualized here. You can see that XIT has returned 19.39% annually over the last 10 years, and the NASDAQ has returned 18.05%. This is actually a lot tighter than I thought. I initially said that it had crushed the NASDAQ, but the NASDAQ has held up quite well relative to XIT. The S&P has lagged quite a bit, obviously, but the S&P is also not pure tech. When we go over the last 5 years, the NASDAQ has started to outperform it. When we go over the last 3 years, it's actually been one of the worst performing, and the main reason for this is the fall of Shopify. If we look at the price of Shopify relative to this, we can see, I mean, the green line is Shopify here. We can really see where XIT started to struggle, and this is why I wanted to highlight that concentration risk. And we can see here in late 2021, Shopify hits all-time highs, and as it falls, we can see that XIT, the purple line here, starts to drag. So that's not all that surprising, and Constellation Software actually has saved this fund from a much larger drawdown. I mean, if we add CSU into this list, we can see that Constellation has outpaced all these funds, and it's up 117% over the last 3 years. So Constellation has offset the decline in XIT's other holdings, primarily Shopify, but not necessarily all Shopify. We can see, OpenText has had a rough go over the last while. Lightspeed has had a rough go. BlackBerry has had a rough go. There's a lot of Canadian tech stocks that haven't performed all that well. So the outperformance of Constellation Software in this portfolio has caused it to pretty much tread water over the last 3 years. 21% returns is definitely nothing to shrug at, but it has struggled relative to what it historically does, and that is because of Shopify. Shopify being 25% of the fund, when it struggles, the fund is going to struggle. So important to know that concentration risk. So that's pretty much it for the video. I'm going to save my voice here a little bit because I'm not feeling that good. The main risk with the fund is that concentration risk to Shopify and to Constellation. It's got very heavy weighting into those two. And before you buy this thinking it's a broad-based Canadian Technology ETF, I just wanted to let you know that the top 5 holdings do make up, 85% of the fund. So it's essentially like holding those top 5, and you have very smaller alternative positions in another 21 Canadian tech stocks. It's a great way to get exposure to Constellation Software if you don't have the money to buy an entire share and you're not at a brokerage that does fractional shares like Wealthsimple Trade. This is an alternative that a lot of Canadians use, and in addition to the Constellation Software exposure, it gets you exposure to the other companies as well. As always, everybody, head down below, subscribe to the channel, like the video. Thank you so much for 16,000 subscribers. We couldn't do it without you. Subscribing, liking, it supports the channel. It allows us to create more videos and overall allows us to provide better content for you. And again, remember, I'm going to give away a few premium subscriptions. If you head down below, comment what fund you want me to review next. If you like the video, subscribe to the channel and comment down below. Next week, I'm going to pick a few winners and I'm going to put them in our next video. Until then, we'll see you next time.